Welcome to Chapter 11, Managing Bond Portfolios. In Chapter 10, we priced individual bonds by discounting coupons and principal. Now we move from one security to a portfolio with a job to do. That job may be earning income, tracking a benchmark, protecting capital, funding a pension payment, or meeting a specific liability 5, 10, or 30 years from now. Bond portfolio management is the art of matching cash flow promises to a moving yield curve. The word moving matters. Time passes, yields change, curves steepen, flatten, and twist. Credit spreads widen and tighten. Bonds pay coupons, approach maturity, get called, prepay, default, or become less liquid. Even a portfolio that was perfectly aligned yesterday can drift away from its objective today. This is why duration is more than a formula. Duration connects the timing of cash flows to interest rate sensitivity. Macaulay duration measures the weighted average time to receive the bond's cash flows. Modified duration translates that timing into an approximate percentage price response to a change in yield. Convexity then improves the estimate when the yield change is large enough that a straight line no longer tells the full story. We will also examine immunization. Immunization is designed to protect the ability of assets to meet liabilities when interest rates move. The classic idea is to match the present value and duration of the assets with the present value and duration of the liability. Price risk and reinvestment risk can then offset one another, at least approximately, and under the assumptions of the strategy. The phrase "under the assumptions" deserves its own seat at the table. Immunization does not eliminate credit risk, liquidity risk, model risk, or non-parallel shifts in the yield curve. It also does not eliminate the need to rebalance. A spreadsheet can match duration perfectly and still forget that time passed, the curve twisted, or somebody asked for collateral. Market history gives us reminders. The 1994 bond market sell-off surprised investors who believed bonds moved slowly. The 2022 rate shock produced some of the largest bond losses in decades. In both cases, the cash flow contracts did not suddenly disappear. Their present values changed because required yields changed. By the end of this chapter, you should be able to explain what makes one bond or portfolio more rate sensitive than another, use duration to estimate price movement, compare immunization with cash flow matching, and understand why convexity, rebalancing, credit, and liquidity remain essential. Fixed income may sound calm. The yield curve did not sign that agreement. This chapter has 4 practical learning objectives. First, you should be able to explain how maturity, coupon rate, and yield affect interest rate sensitivity. Longer maturity generally increases sensitivity because more of the bond's value, comes from distant cash flows. Lower coupon also generally increases sensitivity because less money is returned early. Lower yield can increase duration because distant payments receive relatively more present value weight. These are directional relationships, not substitutes for actually measuring the portfolio. Second, you should be able to calculate and interpret duration and modified duration conceptually. Macaulay duration is measured in years. It is the present value weighted average time until cash flows are received. Modified duration converts that measure into an approximate percentage price sensitivity. If modified duration is 7 and yield rises by 1 percentage point, the first order estimate is roughly a 7% price decline. The phrase first order estimate matters. Duration is a tangent line to a curved price yield relationship. It works best for relatively small, approximately parallel yield changes. For larger moves, convexity improves the approximation. For securities whose cash flows change when rates change, such as callable bonds, or mortgage-backed securities, effective duration may be more useful than a cash flow schedule that assumes the future will politely remain fixed. Third, you should be able to describe immunization, rebalancing, and cash flow matching. Immunization typically requires the present value of assets to equal the present value of liabilities, and the duration of assets to equal the liability horizon or liability duration. Cash flow matching goes further by scheduling asset cash flows to meet the liability payments directly. Immunization offers flexibility, while cash flow matching can reduce reinvestment risk. Neither is a free lunch. Finance usually charges for lunch, parking, and the right to read the menu. Fourth, you should be able to explain convexity and active bond portfolio strategies. Active managers can position duration, select points on the yield curve, rotate sectors, trade credit spreads, and seek relative value opportunities. But every active view must be separated from the benchmark exposure and evaluated after trading cost, liquidity, and implementation risk. The assessment focus is application, interpretation, and judgment. A strong answer does not merely state that longer maturity means more risk. It explains the cash flow mechanism, identifies the relevant duration measure, checks the units, and states what else could alter the result. The goal is to understand the decision system. What liability or benchmark is the portfolio serving? Which rate, curve, credit, and liquidity risks does it own? How will those exposures change as time passes? And what would force the manager to rebalance? Duration is not just a number in a fact sheet. It is a description of how quickly the portfolio can change its mind when yields move. The chapter is organized around 4 connected questions. Question 1 is interest rate sensitivity. Bond prices and yields move in opposite directions, but the relationship is nonlinear. A 1 percentage point decline in yield can produce a price gain that is larger than the price loss caused by a 1 percentage point increase, assuming positive convexity. Maturity, coupon, current yield, and embedded options all influence the shape and size of that response. Question 2 is duration. Duration gives us an effective maturity and a first-order measure of price sensitivity. It allows us to compare securities with different coupons and maturities using one common risk language. A 10-year bond does not automatically have a duration of 10 years. If it pays coupons, some value arrives earlier. A 5-year zero-coupon bond, by contrast, has a Macaulay duration of 5 years because its only cash flow arrives at maturity. Question 3 is immunization. A portfolio may be designed not simply to maximize return, but to fund a liability. The manager compares the present value and duration of the assets with the present value and timing of the obligation. When those are aligned, changes in asset value and changes in reinvestment opportunities can offset one another. But the alignment drifts as time passes and markets move, so immunization is a process, not a one-time ceremony. Question 4 is convexity. Duration approximates the price-yield relationship with a straight line. Convexity measures the curvature. Positive convexity is generally helpful because price gains from falling yields are larger, and price losses from rising yields are smaller than the duration-only estimate. But investors often pay for attractive convexity through lower yield, and some securities, especially callable bonds and mortgage-related assets, can exhibit negative convexity in important rate environments. These 4 questions work together. Interest rate sensitivity is the problem. Duration is the first measurement tool. Immunization uses that tool to manage a liability. Convexity and stress testing tell us where the simple approximation can fail. Use this map whenever a bond portfolio is described as conservative. Ask, conservative relative to what? Does it have short duration, high credit quality, strong liquidity, or a close liability match? Those are different claims. The goal is a usable mental model, not a vocabulary list. If a portfolio has a 6-year duration, that does not mean it matures in 6 years, guarantees a 6-year return, or becomes safe after 6 birthdays. It means the timing of its cash flows creates a particular sensitivity to changes in yield. The map turns a chapter from a collection of definitions into a sequence of decisions: measure, match, monitor, and adjust. This slide gathers 6 core concepts. Macaulay duration is the weighted average time to receive a bond's cash flows, where the weights are based on the present value of each payment. It is measured in years. A zero coupon bond's Macaulay duration equals its maturity because every dollar arrives at the end. A coupon bond has a duration shorter than maturity because some present value arrives earlier through coupons. Modified duration converts Macaulay duration into an approximate percentage price sensitivity to a change in yield. For a bond with annual compounding, modified duration is Macaulay duration divided by 1 plus the yield. The exact adjustment changes with payment frequency, but the interpretation remains. Higher modified duration means a larger price response for a given yield change. Immunization is a strategy designed to shield net worth or the ability to fund a liability from interest rate movements. In the basic single liability case, the asset portfolio's present value should cover the liability, and its duration should match the liability's timing. This allows the price effect of a rate change and the reinvestment effect on interim cash flows to offset one another approximately. Rebalancing restores the duration or allocation after the portfolio drifts. Duration changes because time passes, yields move, bonds pay coupons, holdings mature, and the liability horizon shrinks. Immunization without rebalancing is like setting a thermostat once in January and assuming the weather has accepted the arrangement, cash flow matching schedules bond payments to meet obligations directly. If $1 million is due in 5 years, a default-free zero coupon bond paying $1 million in 5 years is the cleanest conceptual match. For a stream of liabilities, the manager can construct a dedicated portfolio with coupons and maturities aligned to the payment schedule. Convexity measures the curvature in the price-yield relationship. It improves the duration estimate for larger yield changes. Positive convexity generally helps the bondholder. Negative convexity can emerge when cash flows change against the investor, as with a callable bond that is more likely to be redeemed when rates fall, or a mortgage pool that prepays when refinancing becomes attractive. A strong answer names the concept and explains how it changes the decision. Saying that a bond has a duration of 6 years is only the beginning. The analysis should ask whether 6 years matches the liability, whether the security has embedded options, whether the yield change is small enough for duration to be reliable, and whether credit and liquidity risks remain acceptable. The concepts are tools. The portfolio objective determines which tool matters most. A disciplined liability management process has 6 stages. Step 1 is define the liability, identify the amount, timing, currency, certainty, and legal importance of the future obligation. A single payment in 5 years is easier to match than a 30-year stream of pension benefits indexed to inflation. The liability should be valued using an appropriate discount curve, not a convenient round number selected because it behaves in Excel. Step 2 is select bonds. Choose securities with cash flows, credit quality, liquidity, tax treatment, and optionality consistent with the job. A high-yield bond may offer attractive income, but it is a poor match for a non-negotiable liability if default risk can prevent the cash flow from arriving. A callable bond may also be unreliable if the issuer can remove the bond when rates fall. Step 3 is measure duration. Estimate the duration of both the assets and the liability. For a single fixed payment, liability duration equals the time to payment. For multiple liabilities, duration is the present value weighted average timing of those obligations. The asset calculation must use a duration measure, appropriate to the securities, including effective duration when cash flows can change. Step 4 is immunize, align asset present value with liability, present value and asset duration with liability duration or horizon. The basic logic is that a rate increase lowers the market value of the assets but allows interim cash flows to be reinvested at a higher rate. A rate decrease raises asset value but reduces reinvestment income. At the target horizon, those effects can offset. Step 5 is rebalance. Time passage and market movements break the original match. A portfolio with a 5-year duration today will not simply become a 4-year duration portfolio next year in a perfectly predictable way. Yield changes, coupon payments, trades, and curve shifts alter the result. The manager must monitor and restore the match within defined tolerances. Step 6 is stress test. Parallel rate changes are only one scenario. The yield curve can steepen, flatten, or twist. Credit spreads can widen. Liquidity can disappear. Derivative collateral calls can arrive before the liability is due. The 2022 stress and liability-driven pension strategies in the United Kingdom was a vivid reminder that duration alignment does not eliminate leverage and liquidity risk. Process discipline turns vocabulary into a workflow. Define the obligation, choose the instruments, measure the exposures, align them, monitor the drift, and test what happens when the market refuses to move in the neat pattern used by the model. A good liability strategy does not merely work in the base case, it survives the path to the payment date. The key relationship is approximate percentage price change equals negative modified duration multiplied by the change in yield. Start with the negative sign. Bond prices and required yields move in opposite directions. If yield rises, the present value of the cash flows falls. If yield declines, present value rises. Now, check the units. Modified duration is commonly stated in years, but its practical interpretation is percentage price change per 1 percentage point change in yield. The yield change must be written as a decimal. 50 basis points is 0.5% or 0.005 in the calculation. Suppose a portfolio has a modified duration of 7.2. If yields rise by 75 basis points, the first order estimate is negative 7.2 times 0.0075. That equals negative 0.054, or an approximate price decline of 5.4%. If yields instead fall by 75 basis points, the duration-only estimate is a 5.4% gain. But the actual price change is unlikely to be perfectly symmetric because the price-yield relationship is curved. With positive convexity, the gain from the yield decline will tend to be a little larger than 5.4%, while the loss from the yield increase will tend to be a little smaller. Duration works best for relatively small parallel yield changes. It becomes less reliable when the move is large, the curve changes shape, credit spreads move independently, or the security's cash flows respond to rates. A callable bond may have less upside when yields fall because the chance of being called increases. A mortgage-backed security may extend when rates rise because refinancing slows. The cash flows are not standing still while the analyst uses the formula. The slide also highlights the cash flow determinants of duration. Longer maturity generally raises duration. Lower coupon generally raises duration because less value arrives early. Lower yield generally raises duration because distant cash flows receive more relative weight. Embedded options can change all three relationships. The formula is useful because it gives an immediate risk estimate. It is dangerous when treated as a complete forecast. Duration says what would happen approximately if one defined yield changed and everything else behaved. Markets have a long history of objecting to the phrase everything else. Before calculating, explain the direction. After calculating, interpret the result, then ask what the approximation omitted. Convexity, curve shape, spread risk, optionality, credit, liquidity, and cash flows. This slide compares immunization with cash flow matching. Immunization matches duration to the liability horizon and aligns present value. The portfolio can contain coupon bonds with cash flows before the liability date. Those interim payments create reinvestment risk, but the strategy is designed so that changes in reinvestment income offset changes in bond price. If rates rise, bond prices fall, but coupons can be reinvested at higher rates. If rates fall, prices rise, but reinvestment opportunities become less attractive. The offset is approximate, not magical. It works best under the assumptions used to design the portfolio, often including a relatively parallel shift in yields and stable credit quality. The portfolio also requires rebalancing. As the horizon shortens and the bond cash flows change, the duration match drifts. Cash flow matching takes a more direct approach. The manager selects bonds whose coupon and principal payments line up with the liability schedule. For a single fixed payment, a default-free zero coupon bond maturing on the liability date can provide an exact nominal cash flow match. For multiple obligations, the portfolio can be structured so each period's payments fund that period's liability. Cash flow matching reduces reinvestment risk because the payments are designed to arrive when needed. It can also be expensive or constrained. The right maturities may not exist. Suitable bonds may be illiquid. The portfolio may require more capital or deliver a lower yield. Credit quality still matters because a promised cash flow is useful only if it arrives. The decision depends on the job. A government agency with a legally fixed payment and limited tolerance for uncertainty may prefer a dedicated cash flow match. A pension plan with many long-dated liabilities may use immunization or a broader liability-driven strategy because exact matching across every date would be impractical. There is also a modern implementation lesson. Some liability-driven portfolios use derivatives to obtain duration efficiently. That can conserve capital, but it introduces collateral and liquidity needs. A strategy may match the economic duration of the liability while still facing a margin call tomorrow morning. Duration risk and funding risk are related, but they are not the same risk. The better answer is not always the strategy with the most elegant formula. It is the strategy that meets the obligation under realistic assumptions, with sufficient liquidity, acceptable credit risk, and a governance process capable of rebalancing. Immunization is flexible, but must be maintained. Cash flow matching is direct, but can be costly. Both require the manager to respect the difference between a model cash flow and cash in the account. The modern context is that duration moved from a back office statistic to a front page risk measure. For years after the financial crisis, interest rates were unusually low. Investors searching for income often extended maturity, accepted more credit risk, or both. Long duration bonds produced strong price gains when yields fell, which made duration look like a helpful source of return. Then the rate environment changed. During the rapid repricing beginning in 2022, Treasury yields in other market rates rose sharply. Bond prices fell across many high-quality categories. Investors who thought they owned income discovered that they also owned duration. The coupon was visible. The interest rate sensitivity had been hiding in the fine print, lifting weights. The lesson is not that long-duration bonds are bad. Duration is a tool. It can be valuable when yields fall, when an investor wants to hedge a long liability, or when the expected return compensates for the risk. The lesson is that the investor must know which engine is driving the portfolio. A second example came from the 2023 failure of Silicon Valley Bank. The situation involved far more than one duration number. but the underlying mismatch was instructive. The bank owned long-dated securities whose market values fell as rates rose, while its funding base could leave much faster. When deposit outflows accelerated, unrealized bond losses became a liquidity and capital problem. Duration risk did not operate alone. Asset liability mismatch and funding concentration made it dangerous. That distinction matters for portfolio management. A long duration bond held against a long, stable liability can be sensible. The same bond funded by money that may be needed tomorrow can be a serious mismatch. Risk belongs to the full balance sheet, not just the security. What changed? Rate volatility increased, and investors received a practical education in duration. What stayed the same? Present value math, the inverse price yield relationship, and the need to align assets with objectives. Who benefits? Investors with clear horizons, disciplined rebalancing, and the liquidity to hold through volatility. What risk remains? Curve shifts, spread changes, calls, prepayments, defaults, forced selling, and incorrect assumptions about when cash will be needed. Active bond managers may respond by changing duration, choosing curve positions, rotating sectors, or selecting securities with favorable spread and convexity. Passive managers still make implementation decisions through index construction, turnover, liquidity, and sampling. The modern lesson is not simply know your duration. It is know why you own it, how it interacts with the liability or benchmark, and what could force you to sell before the strategy has time to work. Now consider the practice case. An insurance company owes $1 million in 5 years. It can buy a 5-year zero coupon bond or a coupon bond with a similar present value but a different duration. Start with the liability. It is a single fixed payment due in 5 years. The liability's Macaulay duration is therefore 5 years because all of the cash outflow occurs at that date. If a default-free 5-year zero coupon bond pays $1 million at maturity, it provides an exact cash flow match. Its Macaulay duration is also 5 years. There are no interim coupons to reinvest and no need to sell the bond to fund the liability, assuming the maturity date and payment date align. For illustration, suppose the relevant annual yield is 5%. The present value of $1 million due in 5 years is 1 million divided by 1.05 to the fifth power. That is approximately $783,526. Investing that amount in a default-free zero paying $1 million at maturity would match the nominal liability. Now compare a 5-year coupon bond with the same present value. Its duration will be less than 5 years because some value arrives earlier through coupons. Those early cash flows create reinvestment risk. If rates fall, the coupons may be reinvested at lower rates. The portfolio may not accumulate to the required $1 million unless the asset duration and liability duration are properly matched. To immunize with coupon bonds, the insurer might need a longer maturity bond or a portfolio of bonds whose combined duration equals 5 years. It must also match the present value of the liability. This is the key point. Equal present value alone is not enough. Two portfolios can cost the same today and respond very differently to a rate change. Why is rebalancing necessary? Time passes, so the liability horizon shortens. Bond durations also change as coupons are paid, yields move, and holdings age. The initial match will drift. The insurer needs monitoring rules and tolerance bands, then trades when the mismatch becomes material. How does convexity matter? If yields change substantially, duration alone will not capture the full price response. The zero coupon bond and coupon portfolio can have different convexities. Positive convexity generally improves the outcome relative to the straight line duration estimate, but the difference should be measured rather than assumed. Pause here and make your recommendation. For a single fixed liability, the 5-year default-free zero is conceptually the cleanest solution because it matches both the cash flow and the duration. The coupon bond may still be useful if the zero is unavailable, expensive, illiquid, or inconsistent with another portfolio objective. But it requires reinvestment planning and likely a different maturity or combination of bonds to achieve the duration match. A strong answer also identifies remaining risks: issuer credit, liquidity, taxes, inflation, if the liability is real rather than nominal, and the possibility that the payment date or amount changes. Grade for reasoning. The best response connects present value, duration, reinvestment, convexity, and implementation. A recommendation without the mechanism is a preference. A recommendation with the mechanism is portfolio management. This slide highlights 5 common mistakes. Mistake 1 is using maturity and duration as if they are always identical. They are equal for a zero coupon bond, but a coupon bond usually has a duration shorter than maturity because some cash arrives earlier. Duration is about the timing of present value, not the date, printed most prominently on the security description. Mistake 2 is ignoring coupon effects. Higher coupons generally reduce duration because they return more value sooner. 2 bonds can share the same maturity and yield, but have different interest rate sensitivity because their coupon rates differ. Mistake 3 is assuming immunization never needs rebalancing. A duration match is a snapshot. Time passes, yields move, bonds pay coupons, and the liability horizon changes. Without monitoring an adjustment, the portfolio can drift away from the liability it was designed to protect. Mistake 4 is using duration alone for large yield changes. Duration is a linear approximation to a nonlinear relationship. Convexity improves the estimate. For securities with embedded options, even a conventional convexity measure may be insufficient because the cash flows themselves can change. Mistake 5 is forgetting credit and liquidity risk while focusing on rates. A perfectly duration-matched corporate bond can still default. A security may also be difficult to sell or finance during stress. Rate risk is only one column in the spreadsheet, even when it is the column with the largest font. Additional mistakes deserve attention. Do not assume all yield curve moves are parallel. A portfolio can have the correct overall duration and still be exposed to a steepening, flattening, or twist. Key rate duration can help identify sensitivity at different maturities. Do not assume positive convexity is free. Investors often accept a lower yield for more favorable convexity. Callable bonds and mortgage-backed securities may display negative convexity in the very environments when the investor most wants upside. Do not use historical duration as though it were permanent. Effective duration can change as option exercise probabilities change. A mortgage portfolio may extend when rates rise because homeowners stop refinancing. The portfolio gets longer precisely when rates are moving against it. Finance occasionally has a sense of humor, but it is rarely kind. Finally, do not confuse risk measurement with risk management. Knowing that a portfolio has a duration of 7 is useful. Deciding whether 7 is appropriate for the liability, benchmark, liquidity budget, and investor horizon is the actual work. The easiest errors come from skipping fit assumptions or the full balance sheet context. Duration is not a horoscope. It does not tell you whether the portfolio is good. It tells you one important way the portfolio may move. Here's the knowledge check. Duration is best described as which of the following? A measure of effective maturity and interest rate sensitivity. B, the coupon rate divided by price. C, the credit rating of a bond. Or D, the number of issuers in a portfolio. Pause for a moment and choose your answer. The correct answer is A measure of effective maturity and interest rate sensitivity. Macaulay duration summarizes the present value weighted timing of a bond's cash flows. Modified duration translates that timing into an approximate percentage price sensitivity to a change in yield. Answer B describes a version of current yield. Current yield equals annual coupon income divided by market price. It is an income measure, not a complete measure of interest rate sensitivity. Answer C is credit quality. Ratings can affect required yield and therefore price, but a rating is not duration. A high-quality bond can still have substantial duration risk. Answer D relates loosely to diversification. Owning more issuers may reduce firm-specific credit risk, but issuer count does not measure cash flow timing or rate sensitivity. The distinction is important because bond risk can be separated. Duration measures rate sensitivity. Spread duration measures sensitivity to credit spread changes. Credit analysis addresses default and recovery. Liquidity analysis addresses the cost and ability to trade. A portfolio can score well on one dimension and poorly on another. The correct answer is A. Duration tells us when economic value is received and how price may respond when required yield changes. It is one of the most useful tools in fixed income, provided we remember that useful does not mean complete. Let us close Chapter 11 with 3 takeaways. First, duration links cash flow timing to price sensitivity. Macaulay duration is a weighted average time. Modified duration estimates the percentage price response to a change in yield. Longer maturity, lower coupon, and lower yield generally increase duration, while embedded options can change the relationship. Second, immunization manages interest rate risk, but requires monitoring. The basic strategy aligns asset present value and duration with the liability. The match can reduce sensitivity to rate movements by balancing price risk against reinvestment risk, but time passage, yield changes, curve shifts, and portfolio cash flows cause drift. Rebalancing is part of the strategy, not evidence that the original idea failed. Third, convexity matters when yield changes are large or cash flows are nonlinear. Positive convexity can improve the price response relative to the duration-only estimate. Callable bonds, mortgage-backed securities, and other option-embedded instruments require special care because their expected cash flows can change as rates move. After the slides, the homework asks students to complete the duration and immunization case. The discussion asks whether duration is a risk or a tool. The quiz checks maturity and coupon effects, Macaulay and modified duration, immunization, cash flow matching, rebalancing, convexity, and the limits of the duration approximation. Finish with the question on the slide: what would change my recommendation? Would the liability amount or payment date change? Is the obligation nominal or inflation linked? Are the bonds default free? Does the portfolio need daily liquidity? Are there embedded calls or prepayments? Could the yield curve twist instead of shifting in parallel? Is leverage being used? How quickly can the manager rebalance, and at what transaction cost? Those questions turn duration from a classroom formula into an investment decision. The best bond portfolio is not necessarily the one with the highest yield or the lowest volatility last year. It is the one whose cash flows, rate sensitivity, credit quality, liquidity, and governance fit the job it has been assigned. Next, the course moves into macroeconomic and industry analysis. That transition is natural. Interest rates, inflation, policy, and the business cycle influence the discount rates and credit conditions that bond managers must navigate. For now, remember the central lesson. A liability has a date. A bond portfolio has a moving set of exposures. Managing the portfolio means keeping those two systems aligned while the market does what markets do. Change the assumptions shortly after the spreadsheet is finished.